Hey there, future millionaires. Want to know the secret to doubling your money without needing to be a math genius? Well, you're in the right place. Today, we're diving into the famous 72 rule, a simple trick that shows you exactly how long it'll take for your money to double in an investment without a PhD in finance. Curious? Let's get into it. Welcome back to the channel. I'm your host, and today we're unlocking the mystery behind one of the easiest and most powerful tools in investing, the 72 rule. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss a tip that could change your financial game. Let's get started. So, what exactly is the 72 rule? At its core, the 72 rule is a shortcut for calculating how long it will take for your investment to double, given a fixed rate of return. It's simple. Take the number 72 and divide it by your annual interest rate, and boom, you've got the number of years it'll take for your money to double. Let me break it down for you. Let's say you're investing in a fund that earns 8% annually. So you take 72 divided by 8, and that gives you 9 years. In 9 years, your investment will double. How cool is that? You didn't have to do any crazy equations or pull out a calculator. Just use the 72 rule. Alright, now that we know what the 72 rule is, let's see it in action with a real example. Suppose you invest $10,000 in an account that grows at a consistent rate of 6% per year. Using the 72 rule, let's divide 72 by 6, and that gives us 12 years. In 12 years, your $10,000 investment will double to $20,000. Easy, right? Now I know you're probably thinking, wow, this is easier than I thought. Well, it is. But it gets even better. Imagine if you could get a 10% return on your investments. If you did the math, that's 72 divided by 10, which means 7.2 years for your money to double. Can you say early retirement? Now you might be wondering, okay, this seems like a great tool, but how reliable is it? Great question. The 72 rule is an approximation. It's not perfect. It works best when you're dealing with relatively stable interest rates over a long period of time, but we all know that life and the stock market is unpredictable. It's like trying to predict the weather. Sure, you can look at the forecast, but sometimes a thunderstorm sneaks in when you least expect it. With the 72 rule, if the rate of return changes or if inflation messes with things, it's not going to be spot on. But hey, it's still better than guessing, right? Let's dive deeper with a more detailed example. If you're investing in a high-growth stock with a projected 12% return, you could estimate that your money will double in 72 divided by 12 equals 6 years. However, remember, markets are volatile. The 12% return isn't guaranteed year over year. It's just an estimate to give you a ballpark figure. Alright, now let's talk about the limitations of the 72 rule. The most important thing to remember is that it's an approximation, not an exact science. Why? Because the rule assumes your returns are steady and consistent, but we all know life doesn't always work that way. Let's be real. Investing is a bit like dating. You might think you've found the perfect investment, but then the next day you realize you're dealing with a volatile situation. Markets go up and down, so the 72 rule won't always be accurate if your returns aren't predictable. Another limitation? Inflation. If inflation is eating away at your purchasing power, the real value of your investment might not double in the way you expect. For example, a 10% return might sound amazing, but with inflation at 3%, your actual return might only be 7%. That means it'll take you longer to reach your goal. So, while the 72 rule is a great starting point, keep inflation in mind when planning. So, how can you use the 72 rule to your advantage? It's simple. Start by identifying your target rate of return. If you want your money to double quickly, you need to focus on investments that provide higher returns. But be cautious. Higher returns usually come with higher risk. For example, stocks historically average around 8 to 10% returns per year, but they're also more volatile. On the other hand, bonds might offer lower returns, but they're typically less risky. Knowing the 72 rule can help you decide where you want to invest based on how fast you want your money to grow. One thing I always tell people is, start investing early. The earlier you start, the more time you have for your money to double. And that means less risk in the long run. Time is one of your greatest allies when it comes to growing wealth. Alright, let's wrap it up. The 72 rule is a simple and powerful tool to help you understand how quickly your investment can grow. It's not perfect, but it's a great way to set your expectations when investing for the long term. Whether you're investing in stocks, bonds, or any other asset, knowing the 72 rule can help you make smarter decisions with your money. So, what are you waiting for? Start using the 72 rule to figure out how long it'll take for your investments to double and start making those long-term financial moves today. And remember, the best time to start was yesterday. The second best time is now. If you found this video helpful, smash that like button and don't forget to subscribe to the XTRM Finance channel for more tips and tricks to level up your finances. Got questions or thoughts? Drop a comment below. I'd love to hear your feedback. And hey, share this video with your friends because everyone could use a little more money magic in their lives, right? Thanks for watching, and as always, stay smart, stay savvy, and keep making those investments work for you. Catch you in the next one. Peace.